Welcome back to HD Cast. I'm glad you're here because today we're diving into a story that threads together money, policy, demographics, and power in a way few countries ever have to manage all at once. I'm talking about Japan, a nation whose past 35 years read like an economic thriller. A roaring boom, a sudden bust, a long winter of deflation, and now a surprise return of inflation wrapped in currency turmoil, all while an aging population reshapes society from the inside out and geopolitical tremors grow louder right next door. Over the next minutes, I want to take you from the late 1980s bubble to the yen trading at roughly 160 to the dollar, then into the Japanese wallets, Japanese boardrooms, Asian trading floors, and finally the halls of the government where hard choices are being made. By the end of it, you'll know why the phrase Japanification is on every central banker's lips, why a weak yen can feel like both a blessing and a curse, why the graying of a society matters even if you live thousands of miles away, and what all of this might signal for the rest of the developed world. And remember, we're only setting the stage today. The closing chapter is still unwritten. So, first, let's roll the clock back. Picture Tokyo in 1989. Neon lights, sky-high real estate prices, and a stock market that seemed to climb without end. At the peak, the land under the Imperial Palace was said to be worth more than all the real estate in California. Then almost overnight, the bubble burst. Equity values collapsed, real estate prices cratered, banks sat on mountains of bad loans, and the consumer confidence evaporated. What followed became known as the lost decades, roughly 30 years in which Japan's nominal GDP hardly budged. Prices declined in slow motion, and people adapted to a world where tomorrow would almost certainly be cheaper than today. The average inflation between 1991 and 2021 was negative 0.2%. That may sound tiny, but compounding year after year, it created a mindset. Why buy now if it will cost less next season? Companies trimmed investments, workers accepted stagnant wages, and the policy makers tried every trick in the book: zero interest rates, trillions in quantitative easing, and a short burst of fiscal stimulus known as the Abenomics, yet the prices level barely moved. Then came the shocks of the 2020s. First, the pandemic and the supply chain chaos pushed up global food and fuel costs. Second, Russia's invasion of Ukraine in 2022 jolted energy markets. Third, and the most important one for Japan, the United States Federal Reserve flipped from extraordinary support to aggressive tightening, lifting its benchmark rate from near zero to around 5.25% in under 3 years. Now, investors chasing yield sold their yen-denominated assets and bought higher-yielding US Treasuries. The Bank of Japan, still worried that any premature hike would plunge the country back into deflation, kept its policy rate near zero and capped a 10-year government bond yields through a mechanism called the yield curve control. The rate cap grew wider, capital flowed outwards, and the yen tumbled. From about 110 per dollar in early 2021, it slid past 150, then briefly kissed 160 in the spring of 2025, its weakest level since 1990. A weak currency can be a blessing if you make things the world wants to buy. And Japan certainly does. Cars, machine tools, specialty chemicals, and anime streaming subscriptions, to name a few. Exports in 2024 jumped 12% in value terms, and the companies like Toyota, Sony, Komatsu reported surging overseas revenue once converted back into yen. But remember, Japan imports roughly 88% of its energy. Every barrel of oil, every cargo of liquefied natural gas suddenly cost a lot more in local currency. The same goes for imported wheat from the American Midwest, corn from Brazil, and soy for livestock feed. Households felt it first at the pump and then the supermarket aisles. Core consumer prices, which strip out fresh food, but include processed food and energy, rose 3.2% year on year by mid-2025, which is a kryptonite for a population used to sub 1% moves. And yet, the wages lagged. Annual shunter negotiations, Japan's famous spring wage round, delivered average pay increases of only about 1.5% in both 2023 and 2024. Disposable income, which is adjusted for inflation, actually fell. Households responded by tightening discretionary spending, which is fewer holidays, delayed smartphone upgrades, and a noticeable drop in restaurant food traffic outside tourist hotspots in Tokyo and Osaka. Departmental store sales slipped nearly 6% in real terms. Consumer sentiment surveys compiled by the Cabinet Office showed lifestyle satisfaction at its lowest point since the immediate post-quake year of 2011. Now switch to the supply side and you see another squeeze. Take Toyota, which sources semiconductors from Taiwan, steel from Australia, and wiring harnesses from the factories of Southeast Asia. Now those input costs are priced in dollars. Toyota's CFO told analysts that raw material costs rose by 14% in fiscal 2024, wiping out part of the currency tailwind for exports. Electrical equipment giant Panasonic reported a similar story with robust overseas demand for its batteries, but higher dollar-denominated cobalt and nickel bills. Some of that cost was passed on to the consumers abroad, but not all of it. And operating margins compressed by about 90 basis points. Now, widen the lens to Asia more broadly. South Korea's leaders such as Hyundai and Samsung, whose products compete head-to-head with Japan's offerings, suddenly look pricey in dollar terms. The won slided too, down by 15% versus the dollar since 2021, yet not nearly as much as the yen's 40% drop. Taiwanese manufacturers felt a similar pinch. The result was a mild but noticeable export price war in consumer electronics and auto parts, sucking margins outside supply chains already stressed by post-pandemic inventory swings. Now, analysts at the Asian Development Bank estimate that for every 10% depreciation in yen relative to the yuan or won, Korea's semiconductor export revenue grows slow by roughly 1%, and currency gyrations rarely stay contained. Portfolio managers unloading Japanese bonds often redeployed cash into US treasuries, but a slice detoured into Indian and Brazilian equities chasing growth. Now, those flows supercharged local currencies only to reverse suddenly when risk appetite waned. The Reserve Bank of India spent an estimate $40 billion defending the rupee between 2023 and mid-2025. Brazil's central bank intervened 7 times in 2 months during the yen's sharpest decline. Volatility indexes for emerging market currencies hit levels not seen since the trade war flare-ups of 2018-19. Geopolitics layered new complexity onto this economic stew, where China's military exercises around Taiwan, North Korea's missile launches over Japan's exclusive economic zone, Russia's rapprochement with Beijing after invading Ukraine all nudged Tokyo towards what defense analysts call normalization, a polite word for rearming. The Kishida administration pledged to raise annual defense outlays to 2% of the GDP by 2027, which is aligning with NATO's target. Now that translates to roughly 10 trillion yen a year, which is up from 7.7 trillion and itself is a record. Financing that expansion while servicing a national debt north of 260% of the GDP demands either higher taxes, faster growth, or both. The government chose a mix, a modest hike in defense levies paired with hopes that corporate tax revenues from a weaker yen would fill the rest. Now, skeptics point to the demographic math here, with 29% of citizens already over 65. Social security and healthcare costs are climbing 8% annually. The working age population, on the other hand, shrinks about 600,000 people each year. So let's spend a moment on the demographic curve because it underpins almost every other policy dilemma. Now, if you imagine a country where the median age is 50, picture a rural prefecture where elementary schools close for lack of children and towns offer abandoned houses for the price of a cup of coffee. That's not science fiction, it's Akita, Yamagata, and dozens of other regions across Honshu and Hokkaido today. By 2035, the national labor force is expected to drop below 60 million, down from 69 million in 2020. Robotic companies see opportunity. Japan already deploys about one industrial robot for every 100,000 workers, which is the highest in ratio in the world. But even automation has its limits. Care for elderly still relies heavily on human hands, and nursing home operators warn that shortfalls could reach 300,000 caregivers within a decade. Immigration could relieve some pressure, yet Japan has historically been cautious about large-scale inflows. The technical intern training program, designed to bring in foreign workers on 3 to 5 year visas, employs roughly 400,000 people, and these are people mainly from Vietnam, China, and the Philippines. Now, critics argue it exploits cheap labor without offering path to permanent residency, but it's a debate around the world. In 2024, the Diet passed reforms to convert the scheme into a skill-based system with a clear route to long-term stays, but the uptake remains uncertain. Even if net annual immigration doubled, the demographics say would only offset about a third of the natural population decline. So, we need to look at something else here completely. Let's try and pivot to policy for a second. For years, the Bank of Japan's yield curve control-pinned 10-year government bond yields near zero, letting the state borrow cheaply while trying to nudge inflation expectations higher. Now, that worked during deflation, but as headline prices crossed 2% in 2023, the policy looked increasingly out of tune. Investors started testing the BOJ's resolve, which is selling JGBs and forcing the bank to buy even larger volumes to maintain the cap. In July 2024, the BOJ blinked, widening the target band. Then in 2025 January, it scraped the cap altogether and nudged the overnight rate up to plus 75 basis points. Now, the bond yields jumped to 1.4%, which is still low by global standards, but a seismic move for Japan. And accordingly, mortgage rates followed. The average 30-year fixed loan, once available at 1%, now costs over near 2%. For a nation conditioned to microscopic financing costs, that carries real sticker shock. Corporate Japan is also recalibrating, and after decades of hoarding cash, firms are finally spending on factories of EV batteries, AI chips, and overseas acquisitions priced cheaply in yen terms. SoftBank sold down portions of its Alibaba stake to fund new bets on artificial intelligence startups. Sony tripled its R&D allocation for image sensors used in autonomous vehicles. Even the famously conservative regional banks are dabbling in fintech joint ventures to eke out yield. Culturally, younger Japanese are rewriting social norms. Lifetime employment at a single company is no longer the dream. Side hustles, remote work, and digital nomad visas are gaining traction. Birth rates, though still low at about 1.3 children per woman, show modest upticks in cities offering subsidies for childcare and flexible hours. Now, whether those glimmers turn into a sustained demographic reversal remains an open question. So, where does all of this leave us? Japan stands at a pivot point where currency policy, energy dependency, defense posture, and demographic reality are colliding together. A weaker yen does deliver export growth but imports inflation. Higher interest rates tame prices but risk choking a fragile recovery. More defense spending bolsters security yet strains already stretched finances. And every year the labor pool shrinks a little more. So navigating these trade-offs will require political cohesion, technological breakthroughs, and perhaps a cultural shift towards greater openness. Now, why should somebody in Frankfurt, Sao Paulo, San Francisco care about this? Well, because many rich nations actually trail Japan on the same demographic slope. Germany's median age hits 50 in 2030. Italy's public debt already mirrors Japan's as a share of the GDP. Even China, long praised for its demographic dividend, saw its working population peak in 2015. What happens in Tokyo is now a preview for boardrooms in parliaments across the world. If Japan can engineer a soft landing, harnessing robotics, selective immigration, and smart monetary tweaks, it offers a template for the rest of the world as well. If it stumbles, the cautionary lessons will be equally powerful. That's the canvas we've painted today, a nation wrestling with the aftermath of a historic bubble, coping with imported inflation driven by 40-year low currency, funding the largest defense build-up since World War II, and doing it all while population ages faster than anywhere else on Earth. Now, before we wrap, I just want to say thanks for riding along. If you learned something today, do me a favor. Hit that follow button in your podcast app so you never miss an episode, and share HD Cast with a friend who loves the big picture in tech and finance stories. Your support helps us keep digging deeper and bringing fresh insights every week. I'm your host Harshdeep signing off for today, and I'll catch you in the next one. Bye.